Hello, everyone. Welcome to this webinar titled Rethinking Modern Asset Allocation with Structured Notes. We're going to be talking, as you know, about asset allocation with structured notes with the possibility of doing three things simultaneously: improving diversification, managing risk better, and enhancing return potential, which are three things that are hard to do at the same time. So this is going to be a very interesting discussion. We're going to be talking about how advisors can use this kind of data-driven approach to augment a traditional portfolio in a way that does those things. My name is Julius Buchanan. I'm the editor-in-chief of Wealth Solutions Report, and I'm excited to be here today with Dennis Monohan, who is the head of investment solutions at Halo Investing. How are you doing, Dennis?
Very good, Julius.
Very good. Good to see you.
Very good. Having a good day.
So while folks are still settling in, let's do a little bit of housekeeping really quick. On the right of the screen, you're going to see several buttons. One looks like a chat button up at the top. That is the chat button. That is so everybody can chat together. The second one is going as a speech bubble with a question mark. That is where you can submit questions for us for a Q&A that comes later at the end of this session. And then there's another button there with a bar chart, and that's going to be where we'll ask some questions for you. There'll be quick multiple choice poll questions. And so while everybody is settling in, if we could go ahead and can we start doing that poll there? And again, that's at the third button. Looks like a bar chart. These first questions that we're asking are really going to be so we can understand you, the audience, better, where you're coming from, and so we can tailor our discussion more to your needs. So if we can go ahead and start that. I'll pause for a second there for people to start working on that and thinking about it. And while everybody is doing that, Dennis, can we talk a little bit about, for those who aren't familiar with Halo, talk about Halo, what you do, and what you personally do there. What is your role at Halo? If you could tell us a little bit about that.
Yeah, absolutely. So Halo Investing is about 10 years old right now. It was founded out of Chicago. Our co-founders, one was a tech entrepreneur. Another was a private banker at Credit Suisse, Jason Barcima. Our early mission, I joined Halo pretty early on. I did not know what a structured product was, but it was very intriguing to me. I did learn about the space. I came from the equity and option space, which was already democratized and had plenty of technology. So the goal was basically from one of the co-founders, who was a private banker who used structured products in his clients' portfolios, and he knew all the issues surrounding structured products, right? So about 10 years ago, it was all on a PDF. There were no platforms, and there are two well-known competitors of ours as well, right? So technology started to enter the space. We decided we'll build a platform, we'll help with the product. Jason had seen all the problems advisors had with the product because it wasn't a perfect product, right? It needed some technology, and he had a vision for how he wanted to go about that. So we started kind of building the platform. Early on, you're always just looking for feedback. When we kind of saw advisors that were on the platform on like a Friday night, we're like, oh, I think we have something here. We were getting consistent feedback from our clients. So we are a fintech-enabled structured note platform, right? We kind of focused on the RIA space. It's technology-enabled, but we've gone beyond that. Never mind supporting advisors. We actually support the issuers, the manufacturers with technology. There were some issues over there. We are embedded in some broker-dealers and custodial systems to help with the operational workflows. Never mind just the product itself and kind of how it affects the client's portfolio. There was a lot more to fix. So, right now we got about 100 people. We have some people out in EMEA, mostly in Chicago. We have a 20-person team that covers the nation to help our clients with the product. Beyond that, we've now moved a little bit beyond, I say, structured products, more like protective investing, defined outcome investing, We do have like hedging and monetization. We do work with like option overlay folks. And the reason for that is the way structured products are, there's a lot you can do with them. So there's a lot of problems or outcomes you can like achieve. So we get asked lots of questions and like, hey, can you guys help solve this issue for this client? Or I'm trying to win this new mandate. And sometimes the answer is just no, we can't. But we kept getting asked the same question. Basically, hard to solve problems is really what we're really good at at Halo. For me, I started running operations for 5 years. I ran our tech team when we were building out the platform. I did shift over and helped our field engagement team and ran that. They're the team that really engages in the trenches with the advisors, helping solve the problems. I felt it was good for me to get close to that, make sure that was going well. Did some relationship management. And the last 2 years, it's been head of investment solutions, where I am anything that has to do with helping contextualize the product inside of a client's portfolio, portfolio outcomes, I've been involved with. And that is designing new tools, doing research, some analytics, off the cuff, or which we'll get into later, which is a financial simulation tool that has been designed here at Halo.
Thanks. And for the folks who have come in since we started, basically this is the webinar, Rethinking Modern Asset Allocation with Structured Notes. A couple things to point out is that we're now have a poll open, three questions on the right. If you look at the third button, it looks like a bar chart. If you click on that button, we would appreciate if you could answer those questions so that we get a better idea of what your needs are and how we can tailor this conversation to you. So thanks, Dennis, for the introduction. And let's move on to another question. You started in the RIA space, right? Halo started in the RIA space 10 years ago. Can you talk about why you started with that particular channel and how starting with that channel has shaped you to be the firm that you are and the services you provide today?
I think there was two main drivers for that. One was Jason was an advisor. So we were designed to for that market. He was always seeing things in the context of advisor. Keep in mind, like there's brokerage versions of structured products and advisory versions. I think the second reason was when we talked to the manufacturers, which are the big Wall Street banks, they had said to us, hey, when we see an advisor leave our ecosystem, go out to Fidelity, Schwab, Pershing, we can't get them again. It was kind of like the Holy Grail. If you could, good luck finding them. So we did that. The third thing I would say is that's where advisors have the most choice. They're not like in a walled garden and they could choose to use us or not, or, another competitor. And that's where there was competition, and we believed that we would have the best product and the best service. And so that's where we went. And that was the initial drive. It started working out very well. It's where the assets are going. Mm-hmm. And how it defined us is our platform has always been designed around, and our people, right, for the advisor, right? We're really not for let's say the fixed income desk particularly, or the manufacturer, even though we do those functions and we do help that with technology. Most of our efforts have been involved in advisors. So advisors have been telling us what it is they'd like to see, what it is that they don't like, for about a decade now. So our platform has definitely been heavily influenced by the advisory community.
Right. And then, over the past decade, how has, a very similar related question, how have you seen the structured notes business evolve in that past 10 years?
Good question. When I first showed up, everyone said this was a product that was sold, not bought. I believe it was 70 to 80% brokerage. That has changed. It is now 60 to 70% advisory. It was probably 70, 80% what we call calendar listings, which are off-the-shelf offerings, which the banks create every month. They have a utility. That has flipped on its head as well. You can now reach out to the banks thanks to technology platforms to design your own product, hit several banks at the same time, and try to make sure you're getting best price instead of and striking and executing that day, right? So a lot of our clients like to come in, Liberation Day or whatever day when the markets are getting a little roiled. They can come in. They know they're going to get good pricing. They're going to buy some products on a dip. Client's going to call them up, say what's going on. You have something you can say, right? I just bought you something with 30% protection and 12% yield. I'm putting money to work for you during these troubling times. So I'd say the advisory side and the platforms have really expanded access, and notionals have more than quadrupled, quintupled, I guess, since I've been here, and just the nature of the products and how people think about them has, I think, changed dramatically.
And keeping in theme with for anyone else who's come in recently, we have a poll that's open. If you look at the third button on the right, there's a poll that's open. Just click on that button. You'll see it looks like a bar chart. And also for everyone, the second button there with a question mark is where you can ask us questions, and we will look at those and get to that in a Q&A section at the end of this.
So just to actually follow up on one thing I do want to say, the manufacturers, the issuers have put a ton of money into the technology. They can create the product at scale, it's much cheaper, right? They're used to now being in competition instead of having like a captive audience. They understand that they have to make secondary markets timely, right? And we help our clients liquidate these products. That was a knock on the products, early on. There was a mark, but you couldn't trust it. We have issuers now that are putting marks out every 10 minutes. Some of them, not all, but some. So there's been improvements just on the product in general, as the manufacturers, from feedback from people like Halo, have come to them and say, hey, this is a minimum requirement if you want to stand side by side with the other assets in these portfolios.
So timeliness, and just like you're attracting, like it's a bigger ecosystem now with multiple manufacturers than it was, and they're just getting better at what they're doing on their side that can serve the advisor's client. Is that
absolutely? Yes. Yeah. I think Halo started working with 3 or 4 issuer partners. We have like 17.
Cool. Yeah, that's rapid growth. And just keeping on the focus on advisors there for a second.
Sure.
How should an advisor think about where the structured notes would fit in that asset allocation? So sleeve, replacement, overlay, those are some of the possibilities. So when that advisor looks at it and says, okay, I'm going to do something for my client with a structured note, because there is such a vast range of tools that you can put into that toolbox or into a particular structured note.
Yeah, so structured notes is a broad term, and within that, right, there's income structured notes, there's growth structured notes, there's absolutes. So we talk to many clients, and I got to say, there's a range of opinions as to where these products fit, right? Is it equity exposure? Is it a fixed income replacement? Does it go in the alts bucket? Now, there's been heated debates, right? I think it's the way you run your practice, and then which product are we talking about, right? What degree of protection are we talking about? How many underlying assets are we talking about? How complex of a product are we talking about? Is it just a capped growth note? It's very simple. It's hard to argue that's not equity, right? Right? That's still going to behave like an equity thing, but income is a little bit different, right? That is somewhere in between. Credit risk, it's like equity tail risk. It's a completely different risk spectrum that you're kind of landing on, right? So we are looking to have more conversations with clients about that exact question and get them comfortable about how they're using this product. And because I feel like we've already solved the what is this product? How do I buy this product? How do I manage it? And it's not on a PDF. So now it's more about being very helping advisors with this broad breadth of choice that they have. When you look at the calendar right now, there's 700 offerings every month, right? Which one do I pick? How do I make that decision Do I do 20% protection, 25? Like going through the analytics, like we want to help answer that question in reverse, and we'll get into more of that later.
Yeah, and just adding to what you said there, looking at one of the poll questions, seems we have a 1/3 split about classifying. 1/3 says equity, 1/3 says alternative, and 1/3 says no consistent classification for structured notes. So it really is wide open.
It is wide open, and that's part of the challenge. Right? Where do I put this? And we thought a lot about this, and I think we've come up with some interesting solutions.
Well, this just going back to the title of the webinar that we have here, Rethinking Modern Asset Allocation, that implies that there's an old thinking and a new thinking. So can you guide us from the old thinking to the new thinking that we're discussing there?
Well, the new thinking is about how to get products that have like these defined outcome solutions into the thinking of the rest of the asset classes, because they've kind of been pushed aside. So I think initially the thought was, right, diversification has always been, the theme for decades now. Diversification, that's why you're thinking about going into like private credit, private equity, because the public markets don't get the full spectrum of the market. And then I think there was a lot about like personalization, right? Like, so you did personalization to the portfolios. We think that there's a spot for these defined outcome products, and the use of those products should be driven by like your desired outcomes, right? And there's desired portfolio outcomes, and there's also like behavioral realities, right? There's the ideal portfolio for the client, but then what can the client actually stomach, or what are they very aggressive? Are they too passive? And that's another dimension of this product that can help the advisors get to that correct asset allocation for the client. So there's trying to drive the outcome that they're looking to achieve from a portfolio standpoint. And then there's also those behavioral realities I'm sure everyone on this call deals with every day.
Yeah. So part of this is going to be how you model it, right? So can you talk about that? And this, I'm going to say some words here, a little bit more technical, but non-normal distribution and defined outcome investments. Can you talk about that, the non-normal distribution, defined outcome investments, and why it matters when the advisors look at that?
Good question. So I'd say traditional asset classes that have been in our like planning tools and our simulation tools, they're all kind of run off of Monte Carlo and expected return, standard deviation, correlations, and you run your simulation. If you try to do that with the defined outcome product, whether that's structured products or a RILA or the buffered ETFs, you do not capture like the defined outcome portion of the product, where it is not going to have a normal, bell curve. It's going to land in the protection zone and give you back all your principal, or it's going to pay you consistent coupons, or it might be capped. It might have, there's two major types of protections, soft barrier and a hard buffer. And there is not many simulation software that can actually express that. So we've kind of developed some tools here to help do that, kind of hoping to like lead the way as we've been trying to get our data and our analytics into the broader ecosystem to align better with the public markets, private markets, and then defined outcome.
And going on that, maybe it's better that we talk about the Aura system that you have set up that can kind of visualize some of the things that you just talked about.
Yeah, absolutely. So that is where Aura comes in. So I can share my screen here in a second. So Aura is a financial simulation tool that does support structured products and all major indices, all payoffs, growth, income, absolute, snowballs, catapults. If you know what those last two are, then you're a veteran of the industry. But we have a simulation tool, and I'll show you what our version 1.0 is right here. So Aura, and this has been out about 9 months to a year, so it's relatively new. We call this our 1.0 version, where you're an advisor. You can come in here. This is not typical for a structured note platform, right? And we have our basic 80, 20, 60, 40 portfolios here that we use to help illustrate how these products work. But you could start, let's say we're starting with a moderate allocation, and I was interested in this income note, which is based on S&P and Russell, call it around 11% yield with 25% protection. You can add it to this portfolio. Let's say I'm going to put in 20% allocation to this note. I'm going to stick with that yield that we priced up today. And let's say my client needs to have 60% allocation to equities, but they're nervous, right? So we're going to get equity-like returns. We're going to replace some of this equity exposure with this income note. Maybe they have income needs, but you still want them to be a little bit more aggressive than going into just traditional bonds. If I run the simulation, this is going to run through 10,000 scenarios in about 6-7 seconds. And you're going to start getting traditional metrics that you would see in normal financial modeling, right? So you'll notice this histogram right here with you have your negative returns here on the left and your positive returns on the right. The aqua blue is the normal distribution for the portfolio without a structured product. The purple is the portfolio with a structured product. So these are the end outcomes of the portfolio at the end of 2 years. You'll see on the right-hand side, right, we gave up some of the upside because we replaced some equity exposure. Here, between 0 and 20, it's probably when we landed in the protection zone overall of the portfolio, but we got paid some coupons, so we've shifted more towards the center. It was a soft protection barrier, so if the market really drops, you're beyond your protection, you won't see that, right? But you've kind of tightened it up, right? And you'll see that with a lot of income notes. We do see the expected return went up about 30 basis points. The median return goes up almost 1%. But our favorite stat is the negative outcomes of the portfolio as a whole. That's about a 40% decrease. So it went from about 22% times you'll be negative to about 13, and meaningful increase in your Sharpe ratio. So this is called our do-it-yourself version of Aura. You can come in, bring in any note that you're interested in, put it into the portfolio that most looks like what your client's in and maybe what needs to get to. And then you can replace. You can replace equities. You can replace fixed income. You could put 5 notes in here. You could put 2 notes in here. You do whatever you want. It'll model it. This is available to all clients of Halo. There's no extra charge here. Not every note looks good. We've had some clients with this tool came out. So if my note doesn't look too hot, I'm like, we can probably do better, right? So we've adjusted some of our behaviors. You're also able to, if I downloaded a report here, right? There is a report that you can have a conversation with your clients. It does kind of explain what the note is. It'll have the same stats as the tool, where you'll see the before and after portfolio, a nice description of what this note we're actually talking about and why we're considering putting it into the portfolio, the histogram, a little bit more detail on the percentiles and the histograms. So that's like Aura 2.1, and then that's like the do-it-yourself version, I'd say. So I'll stop sharing for a sec here. But that's relatively new. We're excited. We're coming out with 2.0, and that's really where we're going to change that asset allocation framework thinking in the future.
Got it. So the advisor comes with a particular client's portfolio in mind and looks through the client's eyes, and then looks at the changed distribution there, starts thinking through the behavioral issues and how the client's going to react. That's am I understanding that right? Is that how it goes?
Correct. Yes. So I mean, if you used to normally, I think all of our clients that work with us now, like before something like Halo, get it. They see an income note, they see a growth note, they kind of know what it's going to do. They're very comfortable with it. This is to help illustrate it for those that need to see it in a more traditional sense or a visual sense, or we're starting with how is this going to affect my portfolio, which is, my money, right? That's what I care about. Mm-hmm. So we're starting there and helping people visualize it. We found it very helpful for people that are new to notes, that don't want to understand things. Like if you put growth notes in there, they're going to move up and down with the underlying asset. portfolio implications. No harm, no foul. As long as that's helping you keep your client aligned to their proper allocation, you should go for it. You can get actually extra aggressive with some of them, but that's a different story than that. So that's the main idea of Aura.
Okay. So can you walk us through how you'd use different structured notes, like in a bullish scenario? And this is, I think, just riffing off of what we've been talking about here.
Yeah.
Client needs, aggression, like or risk aversion, bearish, bullish, neutral. Do you have some examples that you can give us to kind of flesh those out?
Yeah. So this is how we're thinking about that. I'll go back to my screen here. So we're going to go behind the scenes a little bit. This is all being released actually today. To start, behind the scenes, we have an asset allocation framework configuration where, depending if you're bullish, neutral, or bearish, and if you're conservative, moderate, aggressive, right, and your portfolio goals, growth, balanced, or income, we'll design a framework with you where, because you land in this bucket, we will say, hey, these are the types of notes and minimum protections and underlyings that should be allowed if this is the bucket you're in. So we can ensure, this is for actually many of our clients, but independent advisors will probably configure this the way Halo sees things. But some of these larger mega RAs that we work with and the home offices we work with, this is to help get command and control over to what notes are going to be put in front of which client, because that's always been an issue in the structured note space, operationally, risk, compliance. So we address this now at the portfolio level. So we can configure this. Let's say, I don't know, your entity doesn't allow snowballs. We just won't allow it, right? So before we go to talking about the portfolio, we design which types of notes should be for the appropriate scenario. After that, we're going to have Aura 2.0, where you will define your market outlook, whether you're bullish, bearish, or neutral. Sort those notes. We've already put them in the portfolio. That's why I call Aura 1.0, do it yourself. We're putting every note in every portfolio at every weighting between 20 and 40%. Let's say I'm going max 15. Well, I gotta move this around. Max 15%. I'm balanced and I have a 2-year time horizon. Now we've gone through about 200 different notes that are allowed in this entity, all 5 portfolios. And then we're going to come back and just suggest, like this S&P Russell Digital has a dramatic effect based on what you've told us about the portfolio for their clients. So maybe you're not interested in Euro stocks. You can review the statistics, and then now you hit select, and now you come into Aura where the note is kind of already been selected. You can look at the story. You can see if there's more details. But that's the asset allocation framework, and it's all driven on your outlook, bearish, bullish, neutral, right? Your portfolio goal, right? And then your response. And now that is a good looking note. So that's how we're thinking of it. I mean, to simply answer that question, right? I'm trying not to share anymore. Yeah, okay. On the asset allocation framework, if you're bearish, why would we give you a growth note? So no growth notes.
You're looking for protection.
Right? We're going to give you maybe a PPN, or we're going to give you an income note, right? Or we're going to go deeper into protection. If you're bullish, we would give you a growth note. Maybe we'll give you a worst of 2. We'll get a levered upside. Right? That can change. If you're neutral, well, now? Now we're going to focus on the portfolio needs. Does it need more income? Are you looking for more growth? All right, are we balanced? Like that. That's that tricky conversation. That's why that poll is split 1/3, 1/3, 1/3, and that's where we're trying to help everybody. Because when you come on the platform and you're new to notes, and I've been with this 10 years, but I still remember the first time I saw them. Back then, I think an income note had 6-7% yield, and I was blown away by that product. They're about 12% now because interest rates were at 0. And I didn't understand how this was possible, even though I had a very deep equity and equity options background.
So one of the things that people say, arguing against structured notes is it's too complex, right? And they say, how am I going to take this to my client? So how do you respond? I mean, you do obviously want a lot of optionality. You want a lot of tools that you can put in that that bespoke basket or a note for the client, but at the same time, you want to let them know that it's not complex; it's actually simple. So how do you
Yeah.
walk that line there?
So, majority of Halo's clients have never used structured
Mm.
notes before we worked with them. That's been true since day one. It used to be like 90%. It's probably 60 because we're getting into some more established entities here. But so most of the time we're working with advisors who are new to the product. So we did have to simplify things. So there's just like 4 components of a note, right? We do have education on the platform. It takes 20, 30 minutes. I think it's pretty concise, but it gets to the point. 4 components of a note. It has a term. That's how long you're investing for. It has an underlying asset. That's going to drive the performance of the structured product. It has protection, and then it has a payoff. You just have to understand what the protection means, understand what the payoff. I think we all get coupons for income notes. There's participation rates on growth, and that's it. Now, designing them and building them, you can build anything you want into these products, but understand those 4 components, and you can understand any structured product.
Got it. Got it. And there's another objection that sometimes comes up about fees. So what do advisors need to look at when you're talking about the costs?
Yes. Good question. So historically, we'll go back to before 2010, right? It is mostly a brokerage product, right? Mostly in the wires, mostly sold. So there was a commission in there, and it's still there. We still work with broker dealer partners, but I don't know, maybe in the early 2000s there was some not great behaviors, right? So the fee is always just embedded in the product, right? So on the advisory side, which is the most popular version of purchase structured note these days, is it's inside the product, right? So there's a distribution fee, there's a desk fee. Ongoing, and let me back up. When you do reverse inquiry, right, and now you go to the banks and you go to JP Morgan and you go to Goldman Sachs and you go to Citi and you say, I want an income note, S&P, NASDAQ, 20% protection, I'm putting in $3 million. They get you an answer in 15 minutes. We run a blind auction here. We don't go back for seconds. We're not looking like a used car salesman to just keep, dragged on. They know they have to get the best price because everyone has access to all the banks through the Halo's platform. So that's compressing the fees on the issuing side, which is why they needed to invest a lot of money in technology, or they wouldn't be competitive. And then the other fees, so ongoing, there's no AUM fee, there's no trail, there's no surrender charges, I've heard it all these days, but what you see is what you get. You put it in your client's portfolio, there'll be no additional management fee, and you'll get exactly the payoff that is advertised.
Okay. Yeah. And there's can you for an advisor who's interested and says, well, I'm one of those that you mentioned. I'm a first timer, but I'd kind of like to put my feet in the water and try it out. So what should they do?
First step I would say is reach out to Halo. Right, there's probably a link on the invite. We do have that team. We have about 20 people cover the advisory space across regionally and across the nation. They are very good at understanding where you are at with the product. They're very good at explaining what your options are. We do have things called like the starter kit, which can dry down like the calendar offerings that we know are going to be there every month. So you want consistency, step one, right? You want to understand a consistent product. So since you're having conversations with your clients, it's not just like a one-off product, right? It's something that should be part of your practice. You understand that you see a client that might, fit a certain persona, and you're going to reach into like your income note bucket, or you're going to reach into your growth note bucket for that client. So we'll guide you towards which products are consistently offered every month and have been for years. And we monitor that in case they change, right? Then you can kind of graduate into reverse inquiry. Some folks jump right into the reverse inquiry. Some jump right in. I need to create this. I have a client, I don't know, they just sold a steel mill. They're worth $50 million, and I need to win this, right? So I need something special. And what's the issue, right? Like we just had one recently where someone didn't like the US dollar, and we were trying to figure out all sorts of ways to hedge it. And just that unique behavioral thing you encounter with your client who might have just come into a windfall. We'll listen to that and we'll give you options. So I guess step one, reach out to Halo if you have questions. We're always happy to help. You'll get access to the platform. We'll get you onboarded. Take the education. It takes 20, 30 minutes. It's really not that hard. If you want to take it twice, you can. But and then we have people here that'll help you.
Okay, and it's we're at 35 past the hour, so we'd like to go ahead and move into the audience Q&A. So just a reminder for everybody, that second button you see on the right with the question mark, that's where you can submit a question. And as we get into that, we'd like to put up 3 more poll questions. That's the third button on the right. It looks like a bar chart, basically to let us know how we did. So if you could answer those while we're going through the Q&A. And so our first question here is, what is the biggest first-time mistake you have seen with respect to structured notes?
The biggest first-time mistake was someone trying to buy a growth note on the triple levered VIX ETF. I think it was an income note, right? I think they were getting like a 35% yield, and that underlying asset pretty much consistently goes down 60% every year. Right? It's really not meant to hold them by. So like chose the wrong underlying. They really wanted to buy it. We were like, do not buy this. There's a reason you're getting this yield. The second most common question I'd say is, can I hedge this? Right? I have this exposure, whatever it happens to be. Let's say it's Tesla. Let's say it's the market, right? Can I hedge this? No. If you buy a Tesla note and you own Tesla, you have more exposure to Tesla. So we do get that question because there's hedged equity, right? Now maybe you want to roll out of some of that and put it into more of a protective sleeve, right? For whatever reason, you're rebalancing, you're nervous, you have cash needs coming up, you have retirement coming up. Maybe it's a way to step out of equities before you go into fixed income. So that's that. We can't hedge it. Now, what we can, like the answer is like, what can we do when I guess when yields were at 0 for the first 5 years? A lot of our advisors came to us, and the small ones were like, "Hey, this isn't going to work, right? They're at 0, right? You can't cut anymore, right? So I need yield." So we were finding the deepest protection fixed income components for years and years and years. Then rates rallied, and that's so Halo's been through multiple market cycles now, and we kind of have a very good understanding as to where to go in this market cycle, which product, because it can be overwhelming.
Okay, another question we have here we received is, where is the market heading over the next few years? So if you can, put your predictions, put your crystal ball out and tell us where you think it's going.
I think the trend towards advisory is going to continue more and more. I believe that these defined outcome products are going to become more and more embedded in the systems that advisors use today, whether that's InvestNet, the Black Diamonds, the Orions, the GeoWealths. We're in contact with all of them. I find that the desire to support the defined outcome products inside of their ecosystems is growing. Right? When an industry goes from 50 billion to like 270 billion, it starts getting attention. It starts getting to the top of the priority list. The second thing that we're seeing is, I call like a lot of our original clients do it yourself, right? They come on our traditional platform, they search for a product, they discuss the product with our team, they manage it on our platform. It's super easy. Dennis, I could never have done that without this platform, but I have 80 structured products in 400 different accounts, right? So can you manage these for me? So managed solutions of these products is starting to be a thing. We've had some clients come. We do offer that. We have an advisory service. We have some structured note strategy managers on our platform that people can subscribe to. And I think we're going to start getting to the next batch of advisors that don't ever really pick an investment product. They're subscribing to like a model. They're outsourcing a lot of the investment advice, but they get the story, but they never had access to it because they would have to go and buy it themselves. So I think the managed solution is really going to change, and I think that's very powerful for you to know consistently, like, okay, I'm going to allocate some of the portfolio to the strategy, and you know what to expect, right? Okay, whatever the strategy you subscribe to, I know that this client is going to get, I don't know, 6 structured notes in this account over the next 3 months. They're going to be, of this flavor. They're going to be of this structure, which I understand. It's going to be for them. It'll strike exactly on that day. Maybe there's some timing. Like you have this story, you just have to understand it, and you know what to expect, and then you move on, and you go on doing what you're good at. So the managed solutions and more integration into the traditional technology providers is where I see this going.
I just want to remind everybody that to click on the third button at the right. We're doing another poll right now. If you could just let us know how we did there, and take a second. It's just multiple choice. And we have time for one more question. So I
see a question here in the secondary market. So here's the question: How robust is the secondary market for structured products? Should this be considered a firm buy and hold versus a trading product? It is for sure not a trading product. It should be intended to be buy and hold. That is when you get the best outcomes. Mm-hmm. There is one scenario where you may want to liquidate a structured note proactively. You are either really close to the cap on a growth note, and you're basically getting risk-free, or you're in a levered growth note and you're really in the money and you've outrun your dreams, and you've already got your 15% annualized yield, but now you're 2x levered. That is a different product, right? We have alerts on the system to help you with that. So proactively, those are the 2 reasons that I could think that you would maybe liquidate. Now, how deep is the secondary market? We get marks from every issuing bank every day on the product. Last year, Halo liquidated probably $500 million worth of structured products for whatever reason, right? The client needed money, the client left. You can liquidate. You just call us, we'll sell it. It's just like a bond. It'll settle in 2 days. We get the prices from we're talking to the banks all the time. They know they have to make a market for it. You're not locked up. There's no surrender charges, no fees. It's very transparent. So those marks are on the Halo platform and in your custodial statements every single day. So if you wake up, it's priced around 97. Hey, I need to go sell it. If the market rallied a little bit, you might get 97.5, 98. If it dropped 10%, you might get 93. It is a live pricing environment, as I said kind of earlier in the webinar. Some of these banks automatically pricing these out 10 minutes, and we have access to those systems. We just hit sold, and that price is locked in. Some you do have to contact on Bloomberg Chat or some other system.
Okay, so there is liquidity. So you're not locked in. Like some people might think, like a private credit is a surprise about being locked in. It's going, Yeah,
you're not. Yeah.
You're not locked in. You actually can liquidate, and like you said, you probably can liquidate same day or within a fraction of a day.
Yes. Well, we have to put the compliance caveats, right? You are selling back to the bank, and as long as they're there, but Goldman Sachs and JP Morgan are still there. They'll buy it back from you. They understand that if they said no, then who would buy it?
Okay, so it's incumbent upon the manufacturers. They know that they have to make the market.
Absolutely, and they do a very good job with that.
Okay. Well, I think we're at the end of time already, and this has been a fascinating discussion. So thanks very much, Dennis. Thanks to everyone who joined. We appreciate you being here. We hope that we've answered all your questions. If you have more questions, then of course contact us. Shoot us an email, shoot Dennis an email. And we want to thank you very much again for joining us.
Thanks, everyone.